I'm going to talk about a whole bunch of different things that aren't necessarily related to each other, but I think that there are two common themes that you all should, I hope, keep in mind. And if you're not a tax person and none of the details are important to you, that's okay, but the two themes should be important. One is, between now and the end of the year, tax planning is going to be extremely important. And two, the IRS has upped its game a great deal in the compliance world. We're going to start with talking about some of presidential candidate Biden's tax proposals. And I want to share these with you not because I'm a fan or not a fan of Mr. Biden, but because just about every tax that there is, he's proposed to increase in some fashion. And should he get elected in November, the last 6 weeks of the year could be incredibly busy. And some of you may want to get a head start on thinking about those things because of the possibility that in 2021, income taxes could be much higher than in 2020. You know, in the olden days, every December, we take all our checks and put them in a drawer, and we wouldn't want to cash a check at the end of the year. We'd wait till next year to put it in the bank so we could defer income, and we'd pay all of our bills at the end of the year so that we could have more expenses and less income in December and reduce our current year taxable income. But when you're faced with a huge possible tax increase, a lot of things have to happen for that to occur. But when you're faced with that, the opposite becomes true. You want all your income in 2020 and all your expenses in 2021. So among President Biden's changes include increasing the individual tax bracket rates back to a highest level of 39.6% from 37%, and adding a 12.4% Social Security payroll tax on salaries and incomes over $400,000. So for people that make more than $400,000, they end up with about a 15% federal tax increase. That's a huge amount, 15 percentage points. A game changer for some people, because if you live in a state like California, if you add up 39.6% and 12%, that puts you over 50. And then in California, if you had 13% more state income tax, people are effectively in over a 60% income tax bracket, with more than 60% of their income going in taxes, just income taxes alone. And that's going to have a dramatic effect on people. Corporate tax rates would also increase from 21 to 28%. Itemized deductions get limited, and capital gains tax rates go away if you make more than $1 million. This becomes very important for people who want to sell a business or sell an asset. There could be as much as a 20% difference in taxes if you sold an asset in 2020 or if you sold it in 2021, if the tax law changes as presidential candidate Biden is proposing. Mr. Biden has been silent on current gift and estate tax rates and exemptions, but he has talked about eliminating something that he calls the step up in basis. And I think that's because he doesn't understand what it is. That's really a conversation for another day. Mr. Biden may try to reduce some taxes or increase some tax credits for people in the very lowest of incomes. I don't want to spend any real time talking about the PPP program. I hope most of you all applied and have qualified and are now working on your forgiveness as much as you can. I want to remind people that to the extent that you have a PPP loan in place, the amount of that loan that is forgiven is not taxable income, but the expenses that you pay with that forgiven portion of the loan are also not tax deductible. This means that a lot of people did not get the tax windfall they thought they were going to get. So back in 2017, Congress enacted a new version of bonus depreciation. And when they enacted this new version of bonus depreciation, they made a mistake and they excluded from the bonus depreciation program the ability to claim bonus depreciation for what we call leasehold improvements and for what the tax code calls qualified improvement property. So finally, in the CARES Act, as part of the fix it for COVID, they fixed this bonus depreciation issue retroactively for qualified improvement property. This created quite an opportunity for some people to go back and amend prior year's tax returns and claim bonus depreciation in prior years, which may create net operating losses to carry forward or carry back. And I'm going to explain that in one more second. So a year or two ago, Congress decided that we didn't like NOL carrybacks anymore. That is the ability to take a loss this year and use it to get a tax refund in a prior year. And if we got rid of that, Congress decided that that was how we were going to make up the economic loss from reducing corporate tax rates to 21%. Well, we had the COVID crisis and Congress decided to help our businesses get some cash, we would allow them to carry their losses back up to 5 years and to suspend for 2020 and to allow carrybacks for years 2018, 2019, and 2020 to occur. So the IRS has published a bunch of notices on how you do that, both for an individual, an S corporation owner, and for other taxpayers. The mechanics of this stuff is really something to go over with your CPA. The deadline for one of the carrybacks expired July 15th. But for some people, being able to depreciate qualified improvement property, think I'm a restaurant or a tenant and I improve my leasehold interest or I build out a restaurant, all those deductions can be bonus depreciated. There's an ability to carry that back and create some losses, which might create some tax refunds. The ability to deduct losses for pass-through entities remains limited in other ways. So in theory, you get the NOL carrybacks, but for all S corporations and partnerships, we always have these rules called basis, at risk, and passive activities, each of which can also limit your ability to deduct a loss. So these NOL carryback rules aren't perfect for everyone, but they should help a lot of people. On the positive side, the CARES Act created some real incentives and some small incentives for charitable giving. First, it said that if you give $300 to charity, it's what we would call an above-the-line deduction. It's not an itemized deduction, and everybody ought to give at least $300 to charity. It's going to give you instant tax savings. For people who itemize, there's no limit on the amount of cash you can give to public charities, not your private foundation, but to public charities. You can give up to 100% of your income to public charities. There's some exclusions for what's called a donor advised fund. And this 100% rule, I don't think allows you to use carry forwards of undeductible charitable contributions from prior years in the current year. There's been an increase in the charitable income tax deduction limits for corporations as well, and an expansion of the ability to take money out of an IRA and give it to charity in 2020. Charitable giving is a planning issue. The next slide deals with some compliance issues that are going to become very difficult for some taxpayers to deal with. So historically, if I bought an interest in a partnership, it was my responsibility to keep track of my income tax basis in my partnership, the same way that if I bought stock in Amazon or Google or IBM, it was my responsibility to keep track of my basis when it came time to sell that interest or for other purposes. Back in 2018, the IRS decided that's not good enough to help us keep track and babysit people and for us to be more productive in the way we audit people. Partnerships now have to report the income tax basis of their partners in the partnership. Well, that's not a record that partnerships have ever kept before, nor have they ever been obligated to keep it, nor might they know all of the information that would impact the income tax basis of a partner. Nonetheless, the IRS instituted this rule in 2018. Then they suspended it for 2019 when everybody complained and said, there's no way we can get this done. It's an impossible request. Now they've reinstituted it for 2020. And they've also provided a new ruling saying how a partnership must compute it, which means either you get it for your partners or you report a number and they tell you how to make that computation. That may not be an accurate computation. Partners may not want to give this information to their partnership. Some of the weird things that impact partnership basis can be sales of partnership interests, the death of a partner, and the death of a partner's spouse. And certain elections can be made that you would make your partnership aware of that in the past, like what's called a 743 or 754 election. But in other circumstances, a partnership might never know that that kind of election or that kind of a transaction took place by a partner. This is an important compliance rule, and it's something to get ahead of. It's not something that you're going to wait until March of 2021 and say, oh, gee, partners, all of a sudden we need all of your information about your tax basis in our partnership, because partners can't get that information together that fast. It's a calculation. Some people may properly have records of their basis in a partnership. Some people may have not very good basis records. And so you need to give your partners notice and a heads up so that they can comply with this obligation and get their partnerships the information that the partnerships are going to need. So historically, a partnership just gave a K-1 to the partner and that was it. Now a partner's got to get some information back to the partnership. And that's going to make life complicated. A couple of years ago, the IRS also changed the way they audit partnerships. And under these new partnership audit rules, there are times when the partnership and not the partner can become the taxpayer. It's very important that people who have old LLC operating agreements and older partnership agreements be sure that they have updated or update their agreements to be sure that they are addressing this issue in some fashion or another. The partnership audit rules also require partnerships and partners to share information with each other. All of these kinds of things are going to be important from a compliance point of view. Most people are not dealing with this in terms of amending older agreements, but when the IRS comes, it might be too late to go deal with a former partner over a partnership audit, and both sides could be upset by the result. The CARES Act fixed a couple of things that they did badly for nonprofits and changed some other nonprofit reporting issues. One of the things that the CARES Act fixed was the ability of nonprofits to be subject to tax when they pay parking expenses for their employees. That change was made to make the nonprofit world similar to the for-profit world when they changed the rules about the deductibility of employer-provided parking to say it's no longer tax deductible. So they made employer parking no longer a tax-deductible expense for businesses, and they made it a taxable transaction for charities. This new CARES Act rule retroactively undid that mistake. For people with private foundations, what they said they did was they simplified the private foundation investment income tax. It used to be there was a 2% tax generally for the investment income of private foundations. You could get a special 1% tax instead if you gave away a lot of money in a particular year, more than you had normally. And the IRS and the Congress decided what we're going to do is we're just going to have a blended rate. All private foundations now are 1.39%. End of story. The IRS has published also a series of rules explaining what the new IRS Code Section 4960 excise tax. Some people think of this as the football tax, the football coach tax. So what the football coach tax is about is anybody who gets more than $1 million in salary from a charity in a year can force the charity to have to pay an extra 21% excise tax, because the theory is that a charity shouldn't be paying that much money. If you're a charity, your employees shouldn't be making $1 million or more. So what's new about this for this year is the IRS has more rules about who's and what salaries are subject to this 21% excise tax for charities and who's not. One of the ways that people have been surprised is some charities that really don't pay their employees a lot of money may have non-qualified retirement plans or insurance benefits that could trigger the application of this tax depending on the nature of those plans and how they work. So that if I retired and I get $1 million employee retirement benefit, even though my salary every year was $150,000, that employee retirement benefit could possibly trigger this tax for a nonprofit. So, very briefly, even when you're a charity, you owe income tax on what's called your unrelated business taxable income, which means if you're a charity but you also own a for-profit business, you can owe income tax on your income attributable to that for-profit business. Historically, under rules prior to 2017, you would net all of your for-profit businesses together, and if one had income and one had a loss, you might not owe any of this unrelated business taxable income or unrelated business tax. The rules were changed and the computations are now made separately for each business activity that a charity engages in. So if you have one activity that's very profitable and one that you lost money in, if they're totally unrelated activities, you can no longer net them against each other. So I mentioned briefly about the parking lot tax, and as part of the parking lot tax rules and the changes to the rules for employer provided parking, they also got rid of the deductibility for entertainment expenses. That is, business entertainment expenses aren't deductible. Business meal expenses, which meet the detailed IRS rules about being with a customer, having proper documentation, which is definitely something you need to worry about and keep track of. Meal and entertainment expense deductions are something that the IRS loves to ask questions about. They think it's an easy thing to address in an audit. Some people don't keep good records for that reason, so the IRS can have all their meals and entertainment expense deductions back if they have to, and maybe they'll look there instead of someplace else. But the IRS has upped its game on auditing meal expenses, and they changed rules so that entertainment expenses are no longer deductible. Sweets, it's not just sweets in a football game that aren't deductible. Football tickets are no longer deductible. Meals remain deductible even if they are provided with entertainment, as long as they're billed separately and you have separate receipts. So if I buy a football ticket and for a client, and I take the client to a game and I buy him a hot dog, if I save a receipt for the hot dog, I can deduct half the cost of the hot dog. I can't deduct anything for the football ticket. The same is true in a suite or other kinds of food and beverage expenses, as long as they're separately invoiced and separate records are kept, and it also relates to business entertainment. The IRS continues to refine its regulations about the deductibility of certain administrative expenses of trusts and how those expenses pass through to the beneficiaries at the termination of the trust. There have been several recent IRS rules issued on this and some comments received back. It's a technical area for people who are wrapping up estates and trusts. It can be important to understand how things flow out. If your business owner passed away, this could be important to you. For the average person, this may not impact them very much. Many of you have heard about qualified opportunity zones. Some of you may have been involved in qualified opportunity zone investments. Qualified opportunity zones are the opportunity to make investments in certain geographic areas, and if you do, you get to defer capital gain from another transaction, including possibly even from the sale of public securities. So you could sell your Amazon stock and reinvest the proceeds in a qualified opportunity fund or qualified opportunity zone business and defer some income tax, maybe save a little tax. What's important recently is that the IRS extended the deadline because of COVID issues. It gave people a little bit of extra time for qualified opportunity zone compliance. Lots of us have independent contractors. Two things about independent contractors to be careful of. The IRS and a number of states are being very aggressive in trying to recharacterize payments to independent contractors as payments to employees. We've seen several audits locally on this issue recently. Our clients have similar issues and problems in other states. California is an anti-independent contractor state. I feel like it's impossible to have an independent contractor in California these days. So from a general compliance point of view, auditing this issue is very common. Where you have independent contractors, it's best to be sure they really are 1099 folks and not W-2 folks, because there are a lot more compliance headaches that businesses are dealing with over this issue. To help the IRS keep track of this, they have changed the 1099 form for independent contractors who are paid for services. You issue a new kind of 1099 form called a 1099 NEC, as opposed to something like a 1099 miscellaneous or other 1099 that you might issue. This is going to become a problem for some people to remember to use the new form. It also highlights the attention the IRS is giving to this form. Quick positive note: Louisiana franchise tax is suspended by the legislature from July 1, 2020 through June 30, 2021. It overlaps a calendar year. Why they couldn't do it for a calendar year, I don't know. because again, it just makes reporting and compliance more complicated. But for those subject to the franchise tax, we'll take the relief that we can get. Specifically, the tax is only suspended for small businesses that have up to $500,000 of taxable capital. I want to spend a couple of minutes and talk about state and local income taxes. A couple of years ago, the Supreme Court issued a decision called South Dakota versus Wayfair. And what that court case said was that if you sell products online into a state, that state can impose sales tax. There used to be a set of principles in some older cases that said that just selling something into a state, buying something online in Texas and having it delivered in Louisiana was not a taxable transaction in Louisiana because there was no nexus. Nexus is the state and local tax word for you can't tax me if I don't have nexus in your state because I'm not doing business there. So if I never set foot in the state of California shouldn't be able to tax me. It used to be that nexus was measured by physical presence, and the Wayfair decision has made it clear that state sales taxes and use taxes can be imposed not just based upon physical presence, but based on electronic presence. As a result of this rule and this court decision, every state has gone in a different direction about what transactions and activities they tax online. Louisiana has put in a new set of taxes for what they call marketplace facilitators. And if you have $100,000 in revenue from sales in Louisiana online, or 200 separate Louisiana transactions of sales of tangible personal property and certain other electronically transferred services into Louisiana, Louisiana can impose sales tax on your company under its new sales and use tax statutes for remote sellers. I realize that's a mouthful. Every state and city has done this differently. The threshold, number of transactions, the number of dollars, the rates, they're all different. What activities are taxed are also different. So in some states, they tax what's called software as a service. If I have a computer program and you log into my program and run stuff through my Excel spreadsheet and get a report out of my program operates in Louisiana, but you live in Montana or in the city of Chicago, that software as a service transaction might be subject to sales tax in the city of Chicago, or an online tax not called the sales tax. It's important for anyone who does business electronically today to be aware of all of the different transactions that they engage in and the sales tax rules or other electronic tax rules that apply in those jurisdictions. There are an equal number of international taxes that are starting to be imposed in other countries for electronic transactions as well. State tax compliance is very challenging. It's very frustrating because at times you feel like the compliance cost is more than the revenue or the profit you get from doing business in a jurisdiction. Let's just take a quick example. The state of Alabama had a case last year where they've made it clear that computer software sales are taxable, even if it's customized or off the shelf. Mississippi has a sales and use tax on specified digital products which are electronically transferred. I want to take some time and talk about a number of recent tax cases and some tax litigation issues. In May of 2019, I had a chance to personally visit with the chief counsel of the IRS. And he told me then that he viewed micro-captive insurance companies and conservation easements as tax shelters, and they were on his list, and he was coming to get anybody that had done any one of those kinds of transactions. For those of you who are not aware, a conservation easement is a donation of property to charity where you permanently commit the facade of a building or wetlands, or you permanently commit property for nonprofit purposes. Greatly simplifying that, but that's a basic idea of what a conservation easement is. And a number of people have said, gee, well, if you invest in my partnership for $100, I'm going to give you a $1,000 charitable contribution deduction from the easement that we're going to buy and donate to charity. And for some reason, you're paying $100 in, but the easement that is owned by the partnership is got enough value that it's entitled to take or the promoters tell you that the value of what's being donated to charity, your share of it is $1,000. So I buy the right to get a tax deduction for $100. I get a $1,000 tax deduction. That's the way syndicated conservation easement transactions are promoted and sold. And the IRS has said they're naughty. The IRS has issued a settlement offer saying this is the best deal you're going to get. If you entered into one of these transactions and we catch you, we're going to penalize the heck out of you unless you take our immediate settlement offer. This notice is important. This notice came around the time that the tax court in this month of July alone has already said that 4 conservation easement transactions that it reviewed were bogus and denied anyone any kind of charitable contribution deduction for their participation in the easement transactions. If you know anyone that's been involved in one of these, you just got to be careful. Expect that you're not going to get to keep the deduction that you took. I hope you're wrong. I hope, however, your conservation easement structure was done, it was done in compliance with every single technical requirement of the law, and that you're able to survive this audit. But you should be aware that this is on the IRS hit list, and the IRS has been succeeding in attacking conservation easements in a material way. Similar to conservation easements are micro-captive insurance companies. The tax law blesses the idea that I can form my own private insurance company called a micro-captive, and it offers me some tax benefits for getting into that business. The problem is that a lot of people form these insurance companies, but they aren't really insurance companies. And so the scam that the IRS is worried about is a micro-captive or a small insurance company that's not really in the insurance business. It doesn't have the risk associated with insurance. So if the transactions that my insurance company is involved in insuring are damage from hurricanes in North Dakota, that's not really in the insurance business. If my micro-captive insurance company has never paid a claim in 10 years because of the kinds of insurance that it is selling, it likely also is not a real insurance company. So captive insurance companies are also on the IRS audit list and naughty list, and there have been a large number of recent cases in which the IRS has gone after these captive transactions. If you have a captive, the important thing to do is to be sure it's really in the insurance business and to talk to your consultants and get them to confirm and reconfirm that to you in about 100 different ways. Compliance is important. You can have a legitimate captive insurance company. It's just got to be a real insurance company. Doesn't mean it can't make profit and offer some of the benefits that it's intended to offer, but it's an area to be very careful of today. So there have been a whole bunch of recent cases, as well as all these legislative and regulatory changes. I want to highlight a few of them for you. The first one I want to highlight talks about something I mentioned earlier, which is a little bit about income tax basis. Some people get basis in a partnership because they guarantee a debt of a partnership. And in the Bordelon case, the tax court reconfirmed that a real personal guarantee is sufficient to entitle a guarantor to deduct losses because it gives you basis in an entity. There have also been some recent regulatory changes that talk about some limited guarantees, and the idea that if your guarantee is too limited, then you don't get basis, or the amount of the basis may not be the full amount of the guarantee. So it's important, if you are using a personal guarantee to create basis for income tax losses, that you have a real guarantee, that you don't have something, for example, called a bottom dollar guarantee, which is one of the types of guarantees that's on the IRS naughty list. So, as in most years, there have been a number of IRS cases dealing with family partnerships and donations to children. One of those cases is the Cavallero case. In this case, the taxpayer won. Their people did a better job. Their experts did a better job. It was a well-litigated case. And generally speaking, the valuation favored the taxpayer. Similarly, a slightly favorable case was the Grieve case, which involved the valuation of LLC interests, where someone gave away 99.8% of the non-voting interest in an LLC, and 0.2% of the interests were voting interests. And the IRS had a kind of creative argument. They said, well, who would buy the non-voting interests? The only person who would buy the non-voting interest would also buy the voting interest as well. And the court said you can't analyze it that way. When you analyze property that's being donated or transferred for valuation purposes, you can only analyze a specific asset that was transferred. That's an important case. The Bowles case is one that reminds us of a couple of things. The first thing is family loans, intercompany loans generally should be documented with a promissory note and not just a due to and a due from, and should bear interest and should be made to someone who has a chance to pay it back. Otherwise, it might be treated as a gift. In the Bowles case, what happened was a mother made a bunch of loans to her son, or transactions that she called loans. And what the court said was, well, when you first started making the loans, those were real loans to your son. He had some money, he had an ability to repay it, but your son went broke and you keep giving him money that you called loans after he was broke, and you knew that he would never be able to repay them. Those weren't really loans, those were gifts. And so at some point, the court said here that there's a difference between a loan and a gift, and if you want to make a real loan, it has to look like a real loan. Part of making it look like a real loan is that you have a solvent person on the other side. No real person would loan money to someone who is broke. The Nelson case is a lesson of what not to do as a estate planning lawyer, and a lesson in giving us some comfort that if you do it right, it works, but if you do it wrong, it won't. What the parties did in Nelson were to try to make a transfer of a fixed dollar amount. I donate or sell that number of percentage interest in my company, or units of stock or shares of stock in my company, or units of my limited liability company equal to $500,000. And they do this to be sure that they know for tax purposes the amount of the gift or the sale. And they want that to be quantified in dollar terms, so that if the IRS comes back and says that, well, your shares are really worth $100 a share, not 50, you just go back and amend the number of shares that were transferred, but you don't owe any additional tax because you fixed your transaction from a tax point of view by doing your transaction in dollar terms, not in a number of share terms. The IRS blessed that kind of transaction in a case called Wandry versus Commissioner, and the IRS unblessed it in Nelson, where the taxpayer just did a bad job writing their documents. So Nelson is a case where the taxpayer didn't write his formula valuation clause properly, and that's why he got beat, not because the type of transaction he was trying to do is automatically invalid. So, two more cases that I want to spend a couple of minutes on because I think they're important, and one I want to highlight. The first case is the estate of Moore. In the Moore case, what happened was Mr. Moore had a heart attack. He was given 6 months to live. He left hospice care, and then he created a revocable living trust and a family partnership. And he, quote, donated property to his trust and to the partnership. He sold part of the farm. But even though he sold it and he did all of these transactions, he continued to live in the farm until his death. And the court said, we don't believe any of these transactions was real because you kept living in the farm. If you had really sold this property to a stranger, if you'd really donated it to a partnership, you wouldn't be living there for free. And so everything you did doesn't count for estate and gift tax purposes. We're treating you as owning 100% of this property when you die. This issue has become important. There have been a large number of other cases recently invoking what's known as Section 2036 or Section 2038 of the Internal Revenue Code involving gifts. All of us have clients and bosses who want to give things away for estate tax purposes and keep complete control of the things they've given away. And what these two tax statutes that I talked about say, in the simplest terms, is if you give something away, in quotes, but you keep too many strings around what you gave, it's not really a gift. It's still yours. And so in this case, the Moore case, the court said, you said you gave it away, but you lived there. Nothing changed about your relationship to this piece of property that you said you gave away. You still live there. It was still your house. You were still watching TV there. And, you know, we don't buy that you gave it away. The line on what strings you can have is changing right now. And there have been some recent cases where the IRS has been successful, including a case called the estate of Powell. And it's important just to be aware that if you really want to accomplish an estate and gift transaction and get something out of your estate, you have to give it away and not keep too many strings attached to it. Sometimes those strings can also just come in the form of control. If I put something in the trust, I can't be a trustee of a trust. If I give away 100% of the stock of a business, but I'm still the CEO and all the profits of the business come back to me, and I don't honor the structure that's been created, you have a problem. So setting it up right and not retaining too many strings and legal documents is important. And then, as Mr. Moore learned, what you do is also important. That is, you have to honor the structures that you set up. I want to spend some time talking about this private letter ruling that's listed on the bottom of page 22. This is something that addresses a very common problem that we see. A limited liability company can be taxed as a partnership, or it can be taxed as a subchapter S corporation, or as a old-fashioned C corporation. A large number of people cause their limited liability companies to elect out of partnership treatment and into the subchapter S world. The reason that they tend to do that is because their CPAs tell them that they can save some Social Security tax or self-employment tax by becoming an S corporation. What their CPAs don't always tell them is all of the other ancillary issues that go along with becoming an S corporation. There are all kinds of benefits of remaining as a partnership, even though you might have to pay a little bit more in self-employment tax. But one of the things that happens is S corporations have a rule that every stockholder has to be treated the same. If I own one share of stock and that's 1%, I get 1% of the profits. In the partnership world, those rules are different. I can have all the depreciation deductions and none of the sales revenue. There's any number of ways you can slice income and expenses in a partnership as long as they meet the economic effect tests. And what happens is sometimes we as lawyers draft limited liability companies for clients. We set them up as partnerships. And then without our knowledge, a couple of years later, based on the advice of their CPA, their limited liability company checks a box and elects to become a subchapter S corporation. One of the problems, though, is that they don't go back and review the organizational documents, because the underlying partnership agreement that we drafted may violate the rules for a single class of stock for an S corporation, because it has partnerships and capital accounts and all these special rules for partnership tax. So the good news is the IRS said, well, gee, if you're an S corporation, it's a limited liability company, and you screwed up and you have a partnership style operating agreement for your limited liability company and not an S corporation style operating agreement, as long as you've operated it as an S corporation for tax purposes and done all of your filings correctly, we're going to give you mercy. The bad news is it costs you like $35,000 to get this kind of a private letter ruling. And we've had several clients who we have discovered that they elected S status and didn't change their corporate organizational documents and their operating agreements. And each of them has generally elected not to go get a private letter ruling and to hope the IRS can't figure out what they did wrong. You should nonetheless amend your operating agreement immediately if you have this problem. In other words, if you are an S corporation, you shouldn't have partnership tax provisions in your LLC operating agreement. Simple solution, if you go to sell your business and you have this problem, the buyer may want you to go get one of these private letter rulings. So the sooner you do this in advance, the better. A couple of years ago, the tax law was changed to impose penalties on appraisers who provide what the IRS viewed as a bogus appraisal to the IRS. The problem is the IRS has as many or more bogus appraisals that they do, and the difference between what your appraiser says and the IRS appraiser says can be so big that there's some appraisers that are now scared that they're going to get penalized and subject to this appraisal penalty, not because they did anything wrong, but because the IRS appraisal is so out of whack, or the IRS appraiser is not sufficiently educated to evaluate the situation. There was a recent letter to the IRS about this issue, just something to be aware of, generally speaking. From a planning point of view, we are in a very low interest rate environment. This presents a number of estate planning opportunities. We're also at a time where certain non-tech businesses, oil and gas businesses, for example, have a very low value. So when it comes to gift and estate taxes, now may be the best time to try to transfer interest in a family business to younger generations, whether it's grandchildren, children, great-grandchildren, whether it's by donation, whether it's by a sale. You can loan money to your kids and charge them less than 1% interest on certain loans. You can enter into some charitable gift transactions. And all of these types of planning activities can be very effective, especially in this low interest rate environment. I want to change gears for 1 second and talk about a non-tax issue. And that is a question about um, 401k plans. Many of us have 401k plans for our employees. And a number of 401k plan providers have been sued by their employees, saying, you offered us a bogus 401k plan, or in more simple terms, the 401k plan you offered to us didn't give us good investment choices, or gave us investment choices that involve very high fees and costs. So one of the simple ways that this manifested itself is that there are different classes of mutual funds, of the same mutual fund, that have different fees. So the Thornburg Income Builder Class C fund has a different fee structure than the Thornburg Income Builder Institutional Share Class. And so the question is, and employers have been sued saying, how come you didn't give me the lowest cost version of this mutual fund? Or why did you only give me a chance to invest in this mutual fund, which has been very poorly performing? There have been a large number of class actions in this area, kind of like asbestos litigation or something. And there's been a great deal of success in people suing their plan providers for issues like this. So my advice to you is to review your 401k plan, do your best to be sure that it is in compliance with current fiduciary requirements, that you're offering the lowest cost version of investments that are out there, that the mutual funds that you're offering to your employees are not ranked 99th out of 100, but are better funds. Or if a fund that you start out with that's ranked 10th and it slips to become the 99th worst fund in the country in its investment class, that you get rid of it. So this kind of 401k plan compliance is very important. My time is about up. There is one question that came in about the EIDL loans. There is a $10,000, if you applied for an EIDL loan, you may have received a $10,000 grant associated with it. I don't believe that there's any paperwork that is required to get that grant forgiven. You may have to repay the balance of your EIDL loan. Also, if you applied for an EIDL loan and then you applied after that for a PPP loan, the amount of the EIDL grant, usually $10,000, is treated as part of the forgiven portion of your PPP loan, so that you could end up owing $10,000 back from your PPP loan because of the EIDL grant that you got. You shouldn't get both full PPP forgiveness and the $10,000 EIDL grant to keep. The idea was you get a PPP grant through forgiven debt or the EIDL loan grant.